All right, let's talk about Douglas Emmett, ticker DEI. We're breaking down their Q2 2025 earnings call, and let me tell you, this is more than just a numbers game. This is a story about a real estate giant staring into the future and making a massive company-defining bet on how we're all going to live and work.
So here's how we're going to tackle this. First, we'll get into the weird earnings paradox that had everyone scratching their heads. Then we'll unpack why the stock actually dropped. After that, we'll dive into DEI's huge pivot, look at the risks, and wrap it all up with our official analyst take, the next call.
Okay, so let's jump right into the heart of the mystery here. On paper, Douglas Emmett had a pretty good quarter. I mean, they beat the estimates. But the way the market reacted, yeah, that was something else entirely. It just didn't add up. So you have to ask yourself, right? You report good news, you beat expectations, and your stock gets hammered for it. What in the world is going on? We need to dig into what investors were seeing that the headlines completely missed. And this slide lays it out perfectly. On the left, you've got the good stuff. DEI beats on earnings per share, they beat on revenue. Looks great, right? But then you look to the right, and you see the market's reaction. The stock price falls nearly 4%. That's the disconnect, and that's the puzzle we're here to solve.
All right, so let's peel back the onion here and figure out why. To really get what the market was so nervous about, you've got to look past those shiny headline numbers and get into the weeds, the metrics that truly matter for a real estate investment trust like this.
First, you got to remember the context. Investors were already pretty spooked. I mean, look at this. Year to date, DEI's stock was already down over 20%, while the S&P 500 was up more than 7%. With that kind of performance gap, the company had basically zero room for any bad news. And here's where we find the real story. This number, 37 cents, is their funds from operations, or FFO, per share. For a REIT, FFO is king. It's way more important than regular earnings because it's basically the real cash flow from their properties. And here's the kicker. It was down, and down big, from 46 cents a year ago. That's the kind of thing that makes investors hit the brakes hard.
And if that wasn't enough, there was this monster of a number lurking on the balance sheet. Over $5.5 billion in debt. Now, that's a huge number in any economy, but in a rising rate environment, that kind of debt load goes from being a tool to being a real anchor.
And that debt has a very real, very painful price tag, $65 million. That's how much they paid in interest in just this one quarter. That's cash that's just flying out the door, not being used for growth, not going to shareholders. So you've got less cash coming in and more cash going out. It's the classic 1-2 punch that really spooked the market. But look, management isn't just sitting around watching this happen. They've got a plan, a really ambitious one. And that brings us to their big pivot, a massive strategic move away from their old-school office buildings and straight into the white-hot apartment market.
And the whole strategy really boils down to this: office to residential conversion. The idea is simple, right? You take an office building that's struggling and you turn it into apartments that people are lining up for. But while the concept is simple, actually pulling it off, well, that's a whole different ballgame. It's expensive, it's complicated, but the reward could be enormous.
And to prove they're serious, look no further than their flagship project at 1090 Wilshire. This is a huge, multi-year undertaking to create 320 luxury apartments. But here's the number you really need to focus on, that target return. They're aiming for a yield of over 10% on their money. If they hit that, it's an absolute home run, and the proof of concept for this entire strategy. So why are they so confident they can pull this off? Well, this quote from the CEO, Jordan Kaplan, says it all. Their existing apartment business is just on fire. It's fully occupied, rents are climbing, and income is growing by double digits. So you see, this isn't some wild guess. It's them doubling down on the one part of their business that's already crushing it.
Okay, so the plan sounds pretty compelling. The upside is clear. But, and you knew there was a but coming, this is absolutely not a sure thing. A pivot this big is loaded with risk, so we have to be honest and look at both sides of the coin here. And this table does a great job of laying out the bull versus bear case. On the plus side, their office leasing is still surprisingly solid. They're in amazing markets like LA and Honolulu where it's tough to build, and we know people want apartments there, but then you look at the risks, and they are significant. That huge debt pile we talked about, the sheer risk of trying to pull off these complex projects on time and on budget, and of course, the constant threat of rising interest rates.
All right, we've gone through the earnings mess, the financial pressures, and this incredibly bold new strategy. So let's put it all together. Where do we land? What's our final analysis? It's time to make the call.
So here's our take. You can't think of Douglas Emmett as just an office landlord anymore. This is a full-blown, long-term transformation play. The thesis is simple. If they can successfully turn these offices into apartments, they could unlock a ton of value that's currently hidden. But the catch? Oh, it's a big one. It all comes down to perfect execution over many years, while that giant debt pile hangs over their head. And for that reason, our rating is market perform. The potential is definitely there, but the risks are just as real, which means we think the stock will probably just track the market for now until we get more proof that this grand experiment is actually working.
So really, it all boils down to this one massive question. Can management thread this incredibly difficult needle? Can they execute a complex, expensive, multi-year plan flawlessly, all while juggling billions in debt? How they answer that question is going to be a fascinating story to watch. And as always, please remember, this analysis is for informational purposes only. It is not financial advice.